Well, here we. Oh, don't you love an American recording in process? It's interesting, actually. I don't know why it doesn't say in process, because that's the way all Americans say.
Very true.
Well, good evening to the people that are joining. I can see the numbers ticking up, so that's brilliant. Allow me to talk to my friend Tom Coates. And so, Tom, how's your day been?
Very good, thank you. Yeah, we're. It's an extremely busy week for us, as I'm sure it is for you. This week.
Yeah. Everyone trying to get in before the capital gains tax.
Yes. yeah. So it's pretty frantic at the moment. But
yeah, I bet, which is good. I'll introduce Tom later on a bit closer. What we like to do is we like to give people a chance to join us in case the kettle hasn't brewed quite quick enough, or they haven't been able to get the cork out the bottle or the lid off the beer. But we'll give them a couple of minutes, because we always believe that you should reward the punctual and not hang around. So about a minute, Tom, and then I'll sort of introduce you, and then we'll get cracking, really. I'm looking forward to tonight. It should be fun. I'm not sure that's often said about lawyers, but you know.
No, we're very much a distressed purchase, aren't we? Definitely.
Yeah. Oh, I must go to the a bit like a dentist, though, in a bizarre way, in a way.
Yeah. I used to deliver a seminar actually called "How to Avoid Your Lawyer," which was quite a good title. I always used to think.
I think it's a pretty good one, really, because it's that classic thing, isn't it? People don't really like lawyers. They know they might have to use one, and then quite often they'll avoid using one. But really, they should have used one, because by the time they come round to it, it's going to cost them like 15 times as much, because they shouldn't have really done the things they should have done if they'd have got advice first.
We always contrast ourselves with the accountants. People like their accountants because they save them money. They don't like their lawyers. People don't really ever want to speak to their lawyer, do they?
I never get it, though, really, because surely it's much better. And I know you guys, I know especially you lot, if someone rings you, you'll have a conversation for free. Do you know what I mean? You'll be able to suss out and spec out what they want, and only then will you be able to say, well, this is what you need, this is how much it would cost you. But it gives them a chance.
Yeah, I mean, lawyers have got a bad reputation for, I can't speak to you unless we're on the clock and you're paying me money. And I always say, well, if somebody could make the phone ring with dentists wanting free advice within reason, but if somebody could make the phone ring with people wanting just to speak to me and have a chat, that's gold for me.
Yeah,
absolute gold. Because we're about building relationships longer term.
It is.
We put a lot of time into people at the beginning, which is what a lot of lawyers don't do.
No, right, here we go. Right, I'm going to sort of start now, Tom. So, ladies and gentlemen, thank you for joining us for a webinar with my good friend Tom, actually. So, Tom and I have known each other for possibly 15, 20 years, something like that. And we're both still looking incredibly young. But Tom's a great lad. Tom's a really good, experienced corporate lawyer. He's a no-nonsense northerner. Where him and I work, we worked together in a company called FTA Law, which we set up, didn't we, Tom? We're very successful. Then now we've got Buxton Coates, which is Tom and Sarah Buxton. Where Tom and I truly bond, which is absolutely nothing to do with businesses. We both do like cars quite a lot. So Tom and I have many a moment over maybe a glass of wine or a beer discussed various cars we would like to acquire. Without much further ado, really, Tom, sort of over to you. Enjoy, and I will mute myself and get rid of my picture, because nobody wants to see or hear me, and then just crack on. Now, with questions, we can take them as we go. I just don't want it to disturb your flow. What would you sort of prefer?
I don't mind people raising questions as we go. It can take. I'm happy to be dragged off in any direction that people want to go in. To be honest, okay. What I'm going to do is it's not in any particular order anyway. It's more of a whistle stop tour of anything and everything that might be relevant to a buyer. So go in any direction they want.
Well, I mean, the good thing is that I'm assuming we can send the presentation round to people anyway. And if there's a slide in there that we didn't get to and they want something on it, then give you a call. So, Tom, over to you, and get your screen sharing. Make sure we're ready for that. Yeah. I'm going to, when you've got it up, I'm going to mute myself and disappear. Here we go. This is famous technology. Oh, right. Look at that, Tom.
Well, hang on.
Hang on, we got to turn it into a slideshow now. The reason Tom and I are laughing, ladies and gentlemen, is we had a bit of a moment with this earlier on, trying to get Tom's computer to turn it into a slideshow and not.
It's still not letting me do it. Every time I try and get over to from the beginning,
What can you get to that
it's
little?
it.
Can you get your cursor up to the little right at the top, and you see where it says drilling down?
Yeah.
Can you see the little screen next to it? Go left. There we go.
Mm.
Go left again. Go left.
Mm.
Can you get to that? Oh, not that far. Back again. The bit which looks like a projector. Looks like a projector screen.
Oh, that one. Yeah, yeah.
Yeah.
Got it.
And that.
There
Hey, there we go. Excellent. Right.
Perfect.
I'm going to disappear now, Tom. Have fun.
All right.
If you need anything, just shout because I am still listening.
Will do. Thanks, Chris. Yeah, good evening, everyone, and thanks for tuning in to Drilling Down on the Law, Buying a Dental Practice Safely. I'll start off just with a little bit about myself. Chris has started giving you a little bit of background to that, but I'm Managing Director of Buxton Coates Solicitors. I'm a corporate solicitor. I've been doing it now, but I've been doing corporate law for over 20 years now. And for much of that, it's been almost exclusively buying and selling dental practices and acting for dentists and dental practice owners. And not something I decided by choice to do, but one client became two, and the rest is history, as they say. So yeah, my workload is I'd say 90% dentistry, predominantly buying and selling practices. We deal with business structures, expense sharing agreements, shareholders agreements, NHS issues, contractual points, and within the firm as well, we have a number of other specialisms. As Chris mentioned, we started the firm 10 years ago now, almost exactly 10 years ago. And throughout that time, we've grown to more than 20 staff. We do employment and HR with my colleague, Sarah Buxton, who do a really good employment and HR service, both on a pay-as-you-go basis and on a subscription-based service. We've also got commercial property, because obviously if you're buying and selling a dental practice or any other business, there will always be some bricks and mortar and a property to be dealt with. We've since added commercial litigation, so contractual disputes, that sort of thing. And we do now have a regulatory team as well. So if you unfortunately find yourself in receipt of a letter from the Dental Law Partnership or having issues with the GDC, we're doing plenty of that kind of work now as well. And finally, we've very recently added a compliance expert to the firm, a non-lawyer, which is some might see as a bonus. This is someone who's worked in dental practices for one of the large corporates, managing their CQC and regulatory compliance. So we can help you with all those sorts of things. But yeah, that's just a bit of background about me and my experience. But what you want to hear about is the process of buying a dental practice safely. And the way I'm going to tackle that is I'm going to give you a rundown or a whiz through all of the key issues that I come across, which can be relevant to a buyer or an aspiring purchaser of a dental practice. And as Chris said, do please feel free to raise questions as we go along if anything crops up. So, first thing to speak about, if you are in the process of buying a dental practice, I'd say one of the first things you need to look at is how are you going to buy it? There are a number of ways you can own a dental practice. You could be a sole trader. I'm sure most people understand what a sole trader is, but for those that don't, it means you own it in your own right. You have personal liability to your patients and with under any contracts and that kind of thing. So yeah, sole trader if you're buying on your own. Where you are buying a practice or running a practice with other dental practice owners, you can have an expense sharing partnership. Now, expense sharing is a slightly unusual hybrid, I would say, as to that's peculiar to the dental industry. Similar, I suppose, to barristers' chambers, but we don't come across this type of structure very often. And what it basically means is that multiple dentists working under the same roof who share certain items of common expenditure and overheads, but who crucially maintain their own goodwill. They own their own patient list. And the phrase we use is they eat what they kill. So they're their patients, and that's how it works. But they might share overheads such as premises costs. They might have certain items of common stock that they share with each other. They will probably share the receptionist costs, that sort of thing. So that's expense sharing. And like I say, it's something that's grown up that's pretty peculiar to the dental sector, I would say. So that's what some people do. And that tends to work if you're buying a practice with others and there's going to be a separation in terms of your commitment to the business. So if you were buying a practice with somebody else and one of you didn't want to work there and the other one was going to work there full time, expense sharing will be far more appropriate to that scenario. Alternatively to that, if you're buying with others, you can look at a partnership or a traditional partnership. And by that, we mean you own all of it together, but you take defined shares of income and you're responsible for defined proportions of expenditure. I'd say that that is probably more appropriate to a scenario where you're both working there and doing exactly the same thing, or neither of you are working there. So if you're buying it as an investment, that kind of thing. And then alternative to that is limited company. And we'll talk quite a bit more about limited companies and using a limited company in the context of a practice purchase and owning a practice through a limited company. But basically, if you use a limited company, and some of you may do so in your capacity as associates, we do see that where people practice as associates through a limited company. The company is the owner of the practice. So the company will buy the goodwill, fixtures, fittings and equipment. And that's how that works. I think just on this point, relevant to the business structure that you use, do ensure that whichever one you use, whether you are a sole trader, well, not so relevant to sole trader, but whether you're an expense share or a partnership or a limited company, that you put a proper commercial agreement in place to document that business relationship. So if you're using a limited company and there are two or three of you buying or multiple owners, you want a shareholders agreement. If you're a partnership, you want a partnership agreement. And if you're an expense sharer, you want an expense sharing agreement. And what those agreements do is that they're not so much relevant to your purchase of the practice. They document your business relationship from the point where you buy it. So how are you going to work together? Who's got responsibility for decision making? What are the defined shares of profits? Who's responsible for expenditure? And crucially, what happens if somebody wants to leave or somebody dies? Because those are the most common areas where we see dispute creep into arrangements where people are working together. We've seen examples of people who've been in business for many, many years without a cross word with their business partners. And it only becomes an issue when one of them wants to leave. And if either they haven't got a written documented agreement at all, or they've got one but it's defective and it doesn't cover things like valuation, who pays what, rights of first refusal, that kind of thing, it can end up in hugely costly disputes. It can paralyze the business. You know, we've seen it happen, and all that happens is everybody ends up paying the solicitors to get you to a point where you can get through the stumbling block to actually exiting. So properly drafted agreements are an absolute must, particularly if you're buying with third parties. And that's definitely something that you should keep in mind. Just another point though about sole traders. If you are buying a practice on your own without anybody else, and you are considering being a sole trader rather than a limited company, do keep in mind the risk with the NHS contract inherent in that. We have unfortunately seen scenarios where people have owned practices in their own right, and the legal position is if you die, the NHS contract can and probably will be lost, because there is no legal right for the NHS contract to carry on under those circumstances if a sole practitioner holding an NHS contract dies. And we have seen people's families lose out on the goodwill, sometimes significant goodwill, attached to an NHS contract for that reason. What I'd say is a very useful thing to know with that is that that's not the case if you have multiple people on an NHS contract. So even if you're going to buy a practice in your own name, or you're a sole purchaser. If you can, it can be worthwhile having somebody else on your NHS contract anyway. Work tends to work best if you've got a family member who is also a GDC registered dentist, because they can come onto your contract, particularly if it's a wife or something like that. If something happens to you, the contract continues in the name of the survivor. It's not lost under those circumstances. We call it a nominal partnership, and it's something to really keep in mind from a protection of goodwill point. And we're increasingly seeing our clients. We actually had it quite a bit during the COVID pandemic, where people weren't quite sure how serious this COVID thing was going to be. And we took calls from people saying, I'm a sole trader or a sole practitioner with an NHS contract in my own name. What happens if I die? I'm worried. Can I put somebody on my NHS contract? Well, of course, by that point, it was too late. And the reason it's too late is because the process to add somebody to an NHS contract, which I will come on to in more detail, is an 8 to 12 week process minimum. So it's too late when you're ill or when the worst happens. It's a protection thing that you should look at putting in place now. So moving on, one of the key, I'll give you a bit of a rundown as to how you can acquire NHS goodwill, and also the difference between purchasing assets and purchasing shares, which are two of the fundamental things that are going to dictate how your practice purchase goes. If you've been through the process of acquiring a practice before, you'll be aware of the fact that the NHS contract, or at least the NHS GDS contract, contains the ability to add and remove partners to it. This is with a contract held in the name of individuals, not an NHS contract held in the name of a limited company. I will come on to that. But if you're buying a practice that's either a sole trader or partners, and the NHS contract's in their own name, the way you buy it is notice is served on NHS England to add you onto the contract. And then we serve notice on NHS England to retire the seller from the contract, and that leaves it in the name of you, the buyer. And we call that the partnership route. That's a documented provision of the NHS contract, not something that anybody has to go along to NHS England and ask permission for, as much as they'd like us to. It's a documented legal right under the contract. And that's fine if it's a GDS contract. If it's PDS or PDS ortho, it's not as easy as that, because they don't have those provisions in them. So if you're buying PDS, it can be a bit more complicated as to how you go about buying that. What we tend to find is that the ICBs, they tend to be more amenable with PDS ortho to facilitating a transfer between a buyer and seller. And if all else fails, the seller can sometimes be required to serve notice on NHS England to turn the PDS into a GDS, once again, which is something they are legally allowed to do, thus opening the door to adding and removing partners to it. But sometimes that can come at a cost in terms of renegotiation of contract value and that kind of thing. But as a hard and fast rule, that's the way that we buy and sell NHS goodwill. What that then brings me on to is what happens if we're dealing with limited companies. Now, there are two ways you can buy or sell a practice or any business. You can buy the assets, so that means you buy the fixtures, fittings, goodwill, equipment, so you're only buying the bits and pieces that you actually want to buy. Or you can buy the limited company within which the practice trades. So if the seller is trading as a limited company, the seller will, I am sure, more than likely want to sell their company to you, which will mean you will have to do a share acquisition. So that means you don't buy the fixtures, fittings, goodwill, and equipment. You actually buy the company off the seller that owns the fixtures, fittings, goodwill, and equipment. And you do that by acquiring the entire issued share capital of that company. So you're buying the company under those circumstances and everything that goes with it. Now, a company can have assets, will have assets. It'll own the fixtures, fittings, goodwill, and equipment, but a company will definitely also have liabilities. Up to the point of completion, it will have a corporation tax liability, for example, that relates to the seller's period of ownership. It may have other creditors where it'll have ongoing contractual liabilities. It'll probably have bank loans, all that kind of thing. So acquiring a limited company does come with an added layer of complexity, which requires some specialist expertise, both from your lawyers and your accountants. The financial and accountancy side of it, in particular, is probably the most complex element of it. You really, really need an accountant to work alongside your lawyer if you're doing a share acquisition who understands transactions. We do unfortunately come across transactions where buyers and sellers, depending on which side of the fence we're acting, will say to them, have you got a decent accountant? And the response will be, yeah, absolutely. He or she, they've done my accounts for the last 35 years. They know exactly what they're doing. And it becomes very obvious very quickly to us that whilst they may be an extremely good accountant and they may have saved them a fortune in tax over the years and all the rest of it, what they don't have is transactional experience. And that's a very different thing. It's a very specialist type of accountancy work. It's transactional. And it can be hugely problematic if your accountant doesn't understand some of this stuff. We were dealing with one last week where the seller, and this is from a seller's perspective, but the seller had £1 million in cash reserves built up in their company. And they obviously, as part of the sale, weren't going to give the buyer that money. It has to come out in some way, shape, or form. So the seller has two options, don't they? They either pull it out of the company as dividend and pay tax on it at 30-odd%. They didn't want to do that, surprisingly, on £1 million worth of cash. Or the other thing that we do, and once again, this relies on your accountants and your lawyers knowing what they're doing with this stuff, the money stays in and the buyer acquires the company with the cash still in there. To which you might be saying as a buyer, well, where am I going to find the extra £1 million to pay the seller out for the money that's in the company? And the answer to that is you use the money that's in the company, but you loan it to yourself as the buyer. And that means that the seller gets it as proceeds of sale, capital gains tax rather than dividend rates. And there are no adverse tax consequences to the buyer from doing that as long as your accountant signs off on it. So some complexities to it. But the flip side to it is buying and selling limited companies, it can, in theory, be done quicker because particularly if the NHS contract is in the name of the limited company, doesn't move anywhere, stays where it is. So you buy the company, the NHS contract comes with it. Assuming the company that you're buying is correctly registered for CQC purposes, once again, stays as it is, doesn't need to move anywhere. So in theory, a share deal or a share purchase can actually be done quicker than an asset purchase. And that's something I will elaborate on the next slide. So some of the key initial considerations before you actually get into the bones of acquiring a practice. And I've just set out some of the key things to be keeping in mind. On that point about CQC and NHS contracts, if you're buying assets, as I said before, we can add and remove partners to the NHS contract. But unfortunately, NHS England won't process that notice until they've seen that a CQC registration has been put in place to match the names on the NHS contract. And that's relevant for two reasons. It's relevant because it adds a time barrier to proceedings, because CQC application is 8 to 12 weeks for the CQC to process it from the point the application goes in and is accepted by CQC. And there is then a further 28-day notice period to NHS England to serve notice on the NHS contract. So that's 4 months minimum if you're buying assets and you're doing a partnership route NHS transfer. So that's just something to keep in mind in respect of timescales. I've put CQC and interview on there. And what I would say with that is that if you're a first-time buyer, if you haven't owned a practice before, or indeed even if you do, if you're doing a new CQC registration, it's often the case that they will require an interview. We've come across people who've been incredibly nervous about the interview. We've only ever come across a couple of people, I think, who failed the CQC interview. But it is something to keep in mind. If you already own practices and you've already got a CQC registration, it will be a different process. It'll be a case of adding it to your existing CQC registration. But if it's a new application, you're gonna need to do an interview. We can help with that. We can give some guidance as to what the interview is going to be like. And in fact, our compliance team, which I mentioned at the beginning of the presentation, they actually can do mock interviews and that kind of thing if that's something which is of interest to people. Another thing, obviously a big factor when acquiring, is funding. Where are you going to get your finance from? What's your deposit looking like? As a starting point with that, I would say we always ask the question of our buying clients: have you got your funding in place? And if they say yeah, it's fine, I've spoke to my local bank manager, it's all sorted, we always sort of go, have you got a whole market view? Have you obtained a whole market view? Because there are multiple lenders lending on dental practice goodwill. It's an increasingly competitive market. There are new players coming onto the scene all the time. And what we would always say is speak to a finance broker, particularly one who has experience of the dental sector, and FTA Finance, and David Brewer, who runs FTA Finance, part of the Frank Taylor Group, he's second to none in that regard. So speak to David or somebody like David who can give you that whole market view. Think as part of that, obviously you're going to need to have your numbers and know exactly what you can borrow. Otherwise, how can you go looking at practices you don't know your budget? Something else to keep in mind with banking is what level of security is going to need to be put forward, and have these conversations at the beginning, I would say, because these are some of the things that can become stumbling blocks further down the line, is if the security package, where it's coming from, isn't given due consideration at the start. And by that, I mean, if you're buying a practice and the bank is taking security over the practice that you're buying, that's relatively straightforward. That's as we would expect. Where it becomes a little more complex is if you are either putting up something else as security, and we speak to people about this sometimes, where, yes, the practice is going in, but also I'm putting my house in, or I'm putting my rental property in. Keep in mind with that will add an increased layer of complexity to the legal process, because not only will your bank want due diligence and everything else done into the practice that you're buying, they will also want the same thing done into your family home or your rental property or whatever other assets you're putting up as security. So that is something to keep in mind. Make sure that you run through that with your finance broker at the beginning. Another one that crops up much further down the line, later than it should do, is where people instruct lawyers, they've obtained their finance, and then 3 months into the deal, they say, I want to use a limited company. The difficulty with that is you have to then go back to your finance, because the bank will be lending to you as an individual. If you're using a limited company for some or any part of your practice purchase, make that clear from the outset, both to your lawyers and your financiers. And then another one, just to keep in mind, where this crops up with reasonable regularity, is there can be challenges on the finance side when it comes to buying a share of a practice. So if you're buying into an existing practice, or going into an expense sharing practice, or replacing a partner who's leaving a practice, nothing to be put off by. It's perfectly normal, but you can have a problem with security. And the reason you have a problem with security is because the bank will usually want to take a legal charge over the premises, whether it's a lease or whether it's a freehold. The problem with that is, if you've got 3 partners in the building already, or in the practice already, who are clear of finance and all the rest of it, and you're coming in needing finance, the bank can't take a charge over just your bit of the property. They have to take it over all of it. So what that means is that the 3 existing partners, or 2, or however many there are, would have to sign into the buyer's bank lending. And that can be problematic for obvious reasons. Sellers are not that keen, when they're mortgage free, probably at a different stage in their career, to suddenly be on the hook for the incoming partner's bank lending. To which the banks will say, oh yeah, but you can get around it by putting an indemnity in writing between the 2 parties. Not as simple as that, unfortunately. And the lawyers, once that gets to the lawyers, they will say, oh, well, the problem with that is, if yes, you might have a contract that says if the buyer defaults on the lending, that they will reimburse the other partners if they get stung. You've got to ask yourself, well, under what circumstances would that buyer likely default on the lending? Well, they're clearly having financial difficulties, probably. And under those circumstances, even with the best drafted contract in the world between the parties, if they haven't got the financial means with which to meet a successful claim, it's worthless. So if you're buying a share in a practice or an existing practice and you need to borrow bank funding, it can be helpful if you've got alternative security, whether that's a family home, residential property, that kind of thing. So next point, accountancy input. I think I've already touched upon that, but I'll just reiterate it. Do make sure that you're speaking to your accountant, doing your numbers, looking at what you can afford, that kind of thing. NHS, I've covered that in terms of the process for CQC and partnership route transfer. So I've now got a bit here about property. That's under the heading third-party landlord and freehold. So obviously, if you're buying a practice or buying a share of a practice, there will always be some bricks and mortar to be dealt with. So you're going to need the usual searches and due diligence and things into the property, which I'll come on to. But if there's a third-party landlord, that means that the seller themselves is occupying under a lease because they themselves are a tenant. So you're going to either be taking an assignment of the seller's existing lease, or the seller will be surrendering that lease back to the landlord, and you and your lawyers will then negotiate a new lease with the landlord. I think the hard and fast rule for what I tend to hear and see is that the banks expect to see 10 to 15 years term remaining on a lease. The reason being that obviously they're going to match the terms of their lending to the term remaining on the lease, or the term certain that they know how long you're going to be in occupation for. I think it can be even more problematic if you have a local authority landlord, because local authorities, being as they are, they don't reply at the same pace as perhaps the private sector would. And NHS landlords, that can be problematic as well. Not problematic, but it can be a little bit more fiddly, particularly if it's sort of in a health centre or something like that. So they're just things to keep in mind when you're factoring in your timings. Not reasons to be put off a practice, but just factor it into your timings. And, you need to be speaking to the seller or whatever practice you're buying. You need to know if it's a lease and there's less than 10 years remaining on it. You need an assurance from either the sales broker or the seller themselves, or whoever's put you in touch with this, that lease is extendable. The conversations have been had with the landlord, and there's going to be no problem to having a new lease on 10 to 15 years granted at the point of completion. In addition to that, I've mentioned freehold there. What we sometimes come across are buyers who obviously want the freehold if it's available, but sometimes the financial stretch to acquiring the freehold is a little bit much, because obviously it's a big financial stretch anyway to buy the practice goodwill. Sometimes it's not doable to buy the freehold at the same time. What we're increasingly finding under those circumstances is that we're finding ourselves putting in place things like options and rights of preemption. Now, an option gives you as the buyer the legal ability to come back to the seller at a defined point in the future and require them to sell you the freehold. So you could say, well, I can't afford to buy it now, but I want an option to purchase it in 5 years' time. And you document how it's going to be valued. You can set the value at the beginning. I don't know why anybody would do that, but you can set the value at the beginning, or you can document a detailed valuation mechanism as to how are we going to go about valuing this in 5 years' time so we don't all fall out. And at least then it's all set out in writing and legally binding. Both parties are bound to it. So that's an option. You can also ask for a right of preemption or a right of first refusal. Slightly more watered down version of an option, not quite as buyer friendly, but what it does do, it gives the buyer an assurance that if the seller ever wants to sell the freehold, they come to you first. So they've got to offer it to you first. If you then choose not to buy it, they can go and sell it to who they want. But it gives you that right of first refusal. And we're doing more and more of these for that exact reason. It boils down to the strength of bargaining position between the parties, is what I would say. If you're buying a practice and you're the only show in town, then you can afford to be a little bit more robust in your negotiations and what you ask for. Alternatively, if you're buying a practice and you know that there's a queue a mile long for it and you're facing stiff competition, chances are you're not going to get a seller who is falling over themselves to give you options and rights of first refusal and tie their hands up like that. But it's something to keep in mind, just depending on what your leverage is in negotiations, as we are doing more of those. So the next bit, when you buy a practice, you've found your practice, you've agreed a price, you put the offer in, you've agreed a price, and you've instructed solicitors. So obviously, big thing you want your solicitor to be doing is what we call due diligence. Due diligence is the process by which your lawyers and your financial advisors and your accountants, they get under the bonnet of the business. They ask multiple questions about the state of play, and the seller provides their answers. Our due diligence questionnaire, when acting for buyers, I think runs to about 50 pages, and it goes into all aspects of the practice and its operations. In no particular order, I've set out some of the things which your lawyers need to be looking at as part of the due diligence process. I've got associates at the top of the list. I think that's quite pertinent in this market. I don't think it's any secret that staff recruitment and retention is a challenge for practice owners, whether that's existing practice owners or aspiring ones. The position with the associates is we're finding increasingly fundamental to deal completion. If you're buying a practice, it may be that you don't want the associates or you don't want some of the self-employed staff, in which case that's not a problem. Even if you don't want them, if you're going to go and work there yourself and take over their patients, even if you don't want them, you still want to be making sure that the associates are engaged by the seller on properly drafted associate agreements that contain valid and reasonable restrictive covenants on their future activities. So even if you don't want them and they can go at the point of completion, you still want to ensure that there are documented restrictions on what they can do, because you still don't want them to go and set up around the corner. So even if you don't want them, you still want to be making sure that they are signed up to properly binding associate agreements. If you do want them, it's even more important. But equally, as is always the case, an associate can leave usually on 3 months' notice anyway. So your certainty in that regard it's up for debate, because there's nobody can guarantee the associates aren't going to walk on day one, but it's not our experience that usually happens. But we do find certain buyers of particularly where the associates are crucial to the ongoing viability of the practice, that buyers are less willing to complete until they know they've had those conversations with associates and got them to sign on the dotted line that they are staying, even if it only gives them 3 months certainty. Just so that they don't get wind of the fact that, actually, they're all going to go. So associates is a big one. I think I've got employees and employment issues. Probably one of the highest areas of risk in running any business is what's the state of play with the employees. If you're buying a practice and you're doing it by way of an asset purchase, so you're buying fixtures, fittings, goodwill, and equipment, those employees will transfer over to you on their existing terms and conditions. So the employees are protected. So we get it every now and again where we have a buyer who says, I'm buying this practice. Oh, and by the way, did I mention I'm getting rid of 5 members of staff, or I'm altering their pay or their hours of work? That's easy, isn't it? No, it's not. Within the context of a sale or a purchase, it can actually be quite high risk to make any changes to the employees, particularly on an asset deal where what we call the 2P regulations apply, transfer of undertakings, protection of employees regulations. You'll be expected to confirm as part of the purchase that you're not intending to make any changes to the employees' terms and conditions. So do have a look at that wage bill. Do have a look at, is it something you're comfortable with? Are there any members of staff there where you look at it and you think, that practice manager's been here 35 years and he's on a massive amount of money? If you've the intention of getting rid of somebody that might be problematic or costly, it could be something that you ask the buyer to deal with before you buy it. Because you'd far rather, ask the seller to deal with before you buy it, because and you'll appreciate I advise from both sides of the fence. I act for just as many buyers as I do for sellers. But when advising a buyer, I'd be saying get the seller to deal with that so that the risk is on them. Obviously, if there are family members there, usually, and often there are family members there, the wife's on the payroll or whatever, usually the intention is that they go on completion anyway. They don't want to work for somebody else if they've previously been a family business. Occasionally, we deal with a practice purchase where the wife wants to stay on and has an expectation of staying on as the practice manager. I wouldn't advise it. That can be problematic for obvious reasons. Other things with due diligence, obviously we'll be looking into the equipment. Is it all correctly certified? Is it all in working order? Are there any HP or rental agreements? If so, we'd report to you and say, well, what do you want to do about these? Do you want to keep them, take them on? You might look at them and say, well, actually, that piece of equipment that's on HP, yeah, I wouldn't mind keeping it on. What it boils down to from your perspective is, if there's something there on finance or HP and it's included in the inventory and it forms part of the equipment when you view, when you visit, and how you value the practice and all the rest of it, you have an expectation that you buy it free from encumbrances, as we say. So ideally, you'd be looking for it to be paid off. You don't want to be taking on somebody else's finance, because ultimately it reduces the value of the asset that you're buying. If, for example, between the date of you viewing and placing your offer and agreeing a deal and completion, the seller has, the chair's gone and the seller has gone and replaced a 20-year-old chair with a brand new all singing, all dancing one, so you're getting something better than what you thought you were getting, there may be a conversation to be had where the seller comes and says, actually, come on, you were getting a piece of junk before, you're now getting a Rolls Royce chair, I expect a contribution. But these are all commercial points that can be fleshed out. NHS position, obviously need to look at how the practice is performing. Has it had any breach notices? In particular, at this time of year, deals that are completing, we know that it's too late to make back any historic underperformance for this year. So we're mindful on what's been the position in previous years, because consecutive breach notices can lead to rebasement of the contract later in the year when the NHS do their reconciliation. So need to be careful around that. We want to know the patient numbers, see the accounts under the financial position, any CQC reports, that sort of stuff, and commercial contracts as well. If they've got ongoing financial commitments for things like clinical waste disposal, software of excellence, all this sort of stuff, you might look at it and say, well, actually, they've got a decent deal there, I'm happy to keep it on. But also you might look at it and say, well, no, I can get a better deal than that, so we need them to cancel it. Then we do the contract, and I'll whiz through this because I'm just conscious of time. Sale contract, 50, 60 page document, sometimes more on a share acquisition, nearer 100 pages. Covers off all the legal aspects that need to be covered off to give you the protections that you need. How a treatment's going to be split between buyer and seller, because there will always be an overhang or an overlap, particularly on longer term private treatments or ortho treatments and that sort of stuff, which go on over a period of time. Some of it will have been done by the seller, some of it will have to be completed by you. We need to come up with a documented split for that. Lab bills, you'd expect them to be split on the same basis. Defective treatments, big one. You want certainty that if anything comes out of the woodwork after completion, that you are covered, that you're not having to put clinical neglect right at your own expense. You want the seller to stand by any costs of that sort of thing. You want the seller restricted on what they can do in the future, a bit like we said with the associates, valid and binding restrictive covenants. I'm often asked, what's a reasonable restrictive covenant? Don't know. It depends on the terms of the circumstance of the practice itself. If you were buying a practice in central London, you'd probably be looking to get away with 500 yards as a radius within which the seller can't practice, such as the density of population. If you were buying a practice in the middle of Cumbria, you could probably get away with 10 miles. It all depends on the circumstances of the practice and the density of population around it. Retentions, we do see retentions where people hold money back on the purchase price to cover them off against future anticipated liabilities, particularly Denplan, because that's high risk if there's been incorrect grading and you've then got to put it right after you've purchased, so we can hold money back to cover that. How the price is split, if it's an asset deal, there can be tax benefits or disadvantages as to how you split the price between goodwill, fixtures, fittings and equipment. And then warranties. Warranties are the promises that the seller makes about the state of play with the practice, and you buy on the basis of those warranties, and if it later turns out that they've been untruthful, you have a legal claim against them. I've put deferred consideration / earn out. I wouldn't say it's the norm. It's more of a corporate type thing, but occasionally we do see individual buyers and sellers coming up with some forms of earn-out, by which we mean practice needs to maintain income or grow income by X percentage over X number of years, and you get a staggered payment out of the part of the sale proceeds. So 25% held back depending on future targets and that sort of thing. Like I said, it's more of a corporate type thing, but by no means unheard of at a lower level. And then just quickly, finally, I've put here day one as a practice owner, because whilst I've whizzed through some of the stuff relevant to buying a practice, what I do say to our clients is, that's great. That gets you to day one. That gets you to the point where the practice is yours. But that's actually when the hard work starts. We find that the practices that do best are the ones who put the right systems in place. And what we're finding is the younger generation of practice buyer are far more open to paying to put the correct systems in place. And with that, I mean employment and HR. As a business owner myself, biggest headache of running a business is the employment and HR side of things, the managing of the staff. Any help you can give yourselves in that regard, do it. Whether that's with us, because we've got a great employment and HR team, we can help you with that. But equally, whoever you use, it's like gold, and you don't realise how important it is until you've actually been through an employee dispute. It's incredibly stressful. Make sure you're doing that right from the beginning. Compliance. Have your compliance systems in place with a platform, with a compliance expert. Have a good accountancy. Have a good accountant who provides you with that financial reporting on a monthly basis as a minimum. And as a final point, just as a general commercial term, have an eye on your exit. From the day you buy your practice, I still think you should be looking at, right, what's my exit route, particularly if you've got business partners, which takes me right back to the beginning with the business commercial agreements if you're buying with third parties. Ask the experts. Reiterating what I've said there, dental sector's really well served with solicitors, accountants, sales brokers, financial advisors, recruitment, banking, all pointed at your sector. Whenever I take on a new member of staff who's never worked in dentistry before, and we take them to the trade shows, they're always astounded at the number of specialists that solely serve this sector. And my best piece of advice would be use them. Don't use the solicitor who bought your house or the accountant who does your books or whatever. Use a specialist, because if it goes wrong, it costs far, far more. And there we go. Bang on 45 minutes, I think. There's a QR code at the end as well. If you did like the talk or anything like that, please do leave feedback.
Excellent. Thank you, Tom. That was really good. We got a question coming in, which is quite good. I'll read it out, and you can answer it if you can work out what it is. Buying a company and its subsidiary company, what are the risks if there is intercompany loan that they do not want to write off before completion?
Right. Run that past me again.
Yeah. So it says buying a company and its subsidiary company.
Yeah.
And then it says risks if there is an intercompany loan that they do not want to write off before completion.
Risks if there's an intercompany loan. I don't see an immediate risk. I mean, what I would say with any of this sort of thing is, whilst I have touched upon tax, we always defer to the accountants. So I'm lucky enough to have a working knowledge of some of this stuff, having seen it so many times, but you won't get a solicitor to give you a definitive answer on tax unless they are specialist tax solicitors, because they've got to be FCA registered in order to be able to do it. But my working knowledge of, if there is an intercompany loan, I don't see any adverse tax consequences, because by its very nature, an intercompany loan can sit there indefinitely and doesn't need to be paid back. And that's part of the beauty of it. Whereas directors' loans, if as an individual you take a director's loan out of your company, that has to be paid back within, it's either 8 or 9 months, I think, isn't it?
Yeah, you get hit with a massive tax.
Or you have to declare it as dividend and pay the big tax bill on it. Intercompany loans can sit there for the rest of time and not be.
I presume it's probably, I don't know whether the question might be if you're only buying one of them, but then that wouldn't. I suppose the answer is, well, if you're only buying one of them and it's got a loan, then that has to be discharged and the value is reduced accordingly. Do you know what I mean? That's the only thing I can think of.
I think there's all sorts of creative things you can do with intercompany loans to clear declaring dividends and things like that can be a way of clearing intercompany loans and all this sort of stuff. So on the face of it, if it is a pure intercompany loan and there is a true group structure in place, by which I mean one is a wholly owned subsidiary of the other.
Yeah, yeah.
I can't, off the top of my head, come up with any adverse consequences from that. Definitely not from a legal perspective. Do defer to your accountant rather than me. But I would say my understanding of it is that can sit there for the rest of time without becoming an issue. But
I've got another question coming in. It says, hi, if I'm changing from a sole trader to a limited company as an associate, can I buy a practice on the limited company within a year? Is there a time frame?
No time frame. If you're starting to trade as a limited company in your capacity as an associate, you can use that company. You can use a different one if you wanted to. What we find with associates is it's nice to use the company that they trade as an associate with, because obviously you're getting paid into that, so you can utilize that money that's already within the company structure. But the answer to your question is absolutely no time limit at all. The crucial thing is, actually, if you're using a limited company, is the limited company needs a CQC registration. So once the company is registered for CQC, it can own a practice. The regulations state that the limited company has to have a majority of dental directors, and in its wisdom, the GDC classes one dentist and one non-dentist as a majority of dentists. Don't know why. So 50-50 will satisfy the regulations. So you could even have a partner or a wife or whatever as another director on there. And the real strange aspect of it is, if you're using a limited company, there's no restriction on who the shareholders are. So
I know, nuts.
They don't have to be a dentist.
Anyone can buy it.
Yeah, absolutely. So no time limits or anything like that. As long as you're a GDC registered dentist and you own the company, and that company has a CQC registration, you can buy a practice through it.
Cool. Anyone else throw some questions in, feel free. I had a couple of things just really to reinforce what Tom was saying. HR is a killer. It's a time killer, and it moves so fast. Sarah Buxton, who runs a brilliant HR service called Oracle in Buxton Coates, I remember her doing presentations where she'd say, property law hasn't moved for like 30 years or something, and then HR law probably moved this morning. So HR specialism, and it's quite interesting from a valuer's point of view. We would value lots of practices where there's lots of part-time people, and when you ask the question, why are there lots of part-time people, the principal says, oh, well, I'll have to give them the job when they come back from maternity. And the actual point is you only have to give them back the job they left with. But because they didn't know enough or didn't ask enough questions, you end up with like 12 part-timers, which is chaos.
Yes.
The other thing I also thought, which was really good, was that, keep your eye on the exit. They say, don't you build the business to sell, even if you're never going to sell it. It's a really important thing. What else did I have? The partnership deed. Can't tell you how many times we've seen best mates for 30 years, and it all goes a bit weird when it comes to money, doesn't it, Tom?
Yeah. Oh, yeah, definitely. We had two where, and this is not me saying this. They referred to themselves as two stubborn Scotsmen, was what they said. And as you say, they'd been in business for 20, 30 years, and they only fell out when one of them wanted to go. And the other one obviously didn't want to go into business with anybody else. So there was only one person who could possibly buy him out. That was the continuing one. And they couldn't agree the number. And it went to lawyers, and they ended up not speaking to each other. And they spent tens of thousands because they couldn't communicate. I say to people, yes, the best case scenario is you've got the deed, you've got the agreement, and the rest of it. And that's your gold standard. Absolutely. If you don't, whatever you do, Try and get there by agreement though, because if you end up having to pay lawyers to get you there, yeah, hugely expensive.
Yeah, so I always say to me, it's a bit like a prenup, really. When everyone's really friendly, that's the time to do it. And hopefully, you'll never call upon it. It'll all be done. But regrettably, you and I have both seen it when it's all gone horrendously wrong and cost a fortune. You know,
Yeah.
cost a fortune and health and friendships and all those sort of things.
Yeah, the phrase I always use, it's a euphemism for legal services in general. Is actually, lawyers are actually only here to cover the one time in 100 where things go wrong. 99 times out of 100, it's done honourably on a nod and a handshake. And your best case scenario is you never need to look at the legal documents again. You know,
Yeah.
if everything was done on that basis, we wouldn't have any need for lawyers.
No, that's very true. That's very true. I'll tell you one thing that you mentioned, which has come up a few times, and anyone listening who owns a practice, when there's a lot of cash in the business, and if you're not careful, you can get caught out by Mr. Revenue. So you have to make sure you work out how to treat it. Oh, yes. Here we go. I've got a question coming in, my friend. I've got one that says, congratulations on your 10-year celebration. So that's cool. Coming up. And then I've got another one which says, with buying a limited company, the hire purchase, do they get transferred or settled prior to completion? Right, there you go.
Yeah. Well, if the limited company, if the agreements are in the name of the limited company, the legal position is that they stay, that they will carry on because they will be unaffected by the change of underlying shareholders underneath that. Sometimes you have people who trade as a limited company and they've got their agreements all in personal names and it's all a mess. Whatever. If it's not in the name of the company, unless it's specifically agreed that you'll take it on, you don't take it on. If it is in the name of the company, the starting point is it stays, so i.e. you take it on. But doesn't mean you have to. As long as the solicitor says to you, well, these are the agreements, do you want them or not? If there's an agreement on there that's you don't want because you've already got it somewhere else or you don't think it's on particularly good terms financially, well, then it's a commercial discussion. You go back to the seller and you say, I don't want that one. You're going to have to cancel it at your own expense. But the starting point is, if it's in the name of the company, yes, it carries on.
And as you said, when it's valued, the assumption is that any finance is paid off anyway. So either negotiate a reduction in price or take it on. But yeah, no, brilliant. Yeah. Right. Well, anything else from anybody? I'll tell you one of the great ones I always mention. I'm assuming you still can. Was you know, when there's family members in the business and you make them redundant, is it still the case that you can pay them £30,000 tax free as redundancy?
Yeah. Depending on how comfortable the accountant is. This is that thing about us kicking it back to the accountants again. Yes, in theory, termination of someone's employment, you can pay them a tax-free payment of 30,000. I think it's 30,000. But you have to be careful that it's not seen as a sham. If you like.
But obviously not to be genuine.
Yeah, but I mean, what I always say with this sort of thing is, well, as long what's the worst that can happen under those circumstances? All right, it fails. Okay, so you have to pay the tax on the 30k. Well, you've had to pay the tax on the 30k anyway. What I'm saying is the sellers use it as a convenient way to divert 30k of the proceeds of sale tax free to spouse or to son or daughter or whoever's in the business. And most of the time, the accountants go, yeah, do it. It's absolutely fine. But sometimes we get the odd accountant who says, can't possibly do that. And under those circumstances, we go, fine.
Well, you're not the tax.
Yeah.
I think it just reinforces, doesn't it, that like you said, do not use, and yet again, we've both seen, do not use the bloke who bought and sold your house to do this, because they will mess it up royally. Or the danger isn't people buy and price because it's cheap, but actually they end up costing a fortune because they don't really know what they're doing. So it either costs you money to get it done, or it costs you money to get someone else to do it, or it costs you money because they cock it up. It's so important to use the right advisors.
Yeah, exactly. I mean, we've done at any one time we've got about 50 or 60 practice sales or purchases
How
on the
many
go.
practices do you think you bought or sold in your time, in your 20 odd years?
Well, we average around 100 a year. So you think
Wow.
a typical sort of deal time scale of 6 months, and we've got 50 or 60 on the go at any one time. We sort of say around 100 a year. So we've been in business 10 years as this firm.
Yeah.
So
But then
so
with your experience before, you must have done nearly, working on that, 2,000 transactions. I
yeah,
mean,
well, yeah,
that's,
yeah.
that's probably nearly 25% or 20% of all that take place.
Yeah. We worked out the deal value. We've definitely worked that out, or roughly. Where you add up the total
Yeah,
numbers
yeah.
of all the deals. We quite liked that one because that was a quarter of a billion. We quite liked.
That's not bad. It's quite a nice number to throw in. Yeah.
Yeah.
Just lob it in, and of course, says, yeah, we've done that. Right, right, excellent. I'm conscious it is 8 o'clock. I'd like to say thank you so much, Tom, for that. I always found that was really. I find it fascinating. It's that thing of you sort of in 45 minutes you've lifted the skirt or opened the curtain on all the things you really should think about as a in a dental transaction. And I love the fact of it. That just gets you to the fact you own it. It's all the other bits that once you own it, you should really start looking at as well, because it's crucial to get it right. I've got a couple of questions. I want to see what they are. Here we go. I've got one that says, when you, I don't quite understand that question. When you take too many practices on, don't know. Oh, does that take longer to do deals? I'm afraid I don't quite know the answer to that. I don't really understand the question, I'm afraid. So if you want to give it another go and try and explain it, we'll hang on for a bit. But I say, apart from that, I think it was brilliant, Tom. Love it. So I always find
Pleasure.
it, I must have listened to you talk. I don't know how many webinars and seminars, but every time I find something new.
Yeah, that's good. That's good. And what I do say as well is, like I said at the beginning, we sometimes speak to people for years before it ever turns into any actual chargeable work or anything. So we're very approachable. Anybody who's been listening who has any other questions, and I've whizzed through it to have a conversation. We're always happy to chat and get to know people on a no
Brilliant.
obligation basis.
I'll tell you what, I think we'll go. That person wasn't able to do the question again. But what I would suggest is, where Tom is, you know where we are. So either reach out to Tom directly, because he is Buxton Coates. Tom, I think you're Thomas Coates, aren't you? I think Thomas.Coates at
Yes.
Buxton Coates. Oh, there we go. See if this
Yeah.
is. How do lawyers charge for a completed deal? So let's do that last one, and then we'll say good night.
Yeah, I think really good question. Lawyers have a bad reputation for this kind of thing. Where they give the quote at the beginning and it ends up massively out of kilter at the end with compared to what people were led to believe it was going to cost. I can't speak for other lawyers. What I can say for us is we're very transparent on fees. We'll try and scope it out as much as possible at the beginning, and 99 times out of 100 we can give a fixed fee. If there are real unknowns that we don't know about, we can say, well, look, we don't know about that. We have to look at that separately. Where we give a fixed fee, and whichever firm of lawyers you use, get a fixed fee, so that you know how much you're going to pay. A fixed fee is not a blank check for every piece of legal work that might be necessary under the sun, no matter how unforeseeable. A fixed fee is given on the basis of these are the specific pieces of work that we think are going to be involved in buying that practice. And usually that's where it comes in. Occasionally, there will be items that come out of the woodwork as part of a deal that we never knew was coming. So, for example, if you go and get, suddenly it drops into the deal further down, like, I'm using a limited company. If you use a limited company, the bank will want an enhanced security package, as we call it. So they'll want debentures, personal guarantees, this sort of stuff. And they will insist that your lawyer advises you on that. Extra documentation that we then have to advise on, take the risk on, and do our job properly on. We would quote you separately for that. So, but everything foreseeable, you should get a fixed fee for at the beginning. And in terms of when you pay, how we operate is we raise interim invoices as the deal progresses. So as your time accrues, and we invoice up to a maximum amount of the fixed fee. Virtually all of our deals go over the fixed fee. So if you'd have been paying by the hour, it would have been a far higher price. But we stop when we reach the amount of the fixed fee. And you can expect in a typical deal, we'll probably invoice 2, maybe 3 times across the deal.
Fine. This person has come in with the last question. The refined question. So I'm gonna do it because, hey, we might as well. If you are dealing with 100 practice acquisitions, how can you do them efficiently and not prolong the deals?
Well, we've got a really good team, which we've taken a long time to put together. And I think this person is actually one of our clients, so he will know only too well how good we are at what we do.
Oh, there we go. Brilliant. And I think it's about it's resourcing, isn't it? And being efficient.
Absolutely.
And
at the end of the day, we're only ever as good as the deal that's in front of us and as good as our clients. So,
yeah. Brilliant. Thank you, Tom. Thank you so much for your time this evening. I enjoyed it. I hope everyone else enjoyed it. I found it fascinating as always. Every time I always learn something else that I then use to talk to someone else about. But thank you very much, everybody. And thank you, Tom. And I will now end our webinar. Cheers. Thanks. Bye.
Thank you.